taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. Today, we're talking about a topic that I would normally recommend against, but because of the COVID-19 pandemic, it's something important you should know and possibly have to consider. We're talking about 401k and IRA early withdrawals. A brief refresher on 401k and IRAs. These are government tax-favored accounts. This means you can contribute to these accounts and lower your tax liability in the year in which you do so. Later on, when you withdraw from these accounts, you'll pay taxes at that time. These are tax-deferred savings accounts. Early withdrawals from these types of accounts are typically penalized because the government wants you to save for your retirement. This penalty is typically 10% of the withdrawal. In addition to paying the penalty for any withdrawal, you also need to pay the income taxes. To put this into perspective, let's use an example. Let's say an individual is in the 24% tax bracket and withdraws $5,000 from their 401k. In the year of the withdrawal, the taxpayer will pay $1,700 between income taxes and penalties. As you can see, the government does not take withdrawals lightly. However, this year, because of the COVID-19 pandemic and the CARES Act, taxpayers can actually withdraw up to $100,000 from their 401k or traditional IRA or a combination of these and experience some relief. Before we talk about what some of that relief is, let's address what the IRS has defined as an individual affected by COVID-19. You are a qualified individual if you meet any of the following. You are diagnosed with COVID-19 using a test that has been approved by the CDC. Your spouse is diagnosed with COVID using a test that is approved by the CDC. You experience adverse financial consequences as a result of being furloughed, laid off, hours reduced, or quarantined. You experience adverse financial consequences as a result of not being able to work due to lack of child care as it relates to COVID-19. You experience adverse financial consequences as a result of closing or reducing the hours of a business you own as it relates to COVID-19. Now that we've talked about the definition of a qualified individual, let's talk about what the relief is. First, the 10% penalty on distributions from your 401k or IRA have been removed for 2020. Second, there are no mandatory withholding requirements for the distribution that you receive from your 401k or IRA. Third, the income tax that you still have to pay on the withdrawal can be spread evenly over the next 3 years. And if you happen to pay back that withdrawal within the 3 years, you can actually avoid the tax altogether. Whatever tax you paid in year 1 and year 2, you can claim a refund for in year 3, as long as by year 3, you paid that money back. 4, 401k plan participants can now take a loan of up to $100,000 on 100% of their vested balance and have up to 1 year to start making those payments. These rule changes have made it so much more favorable to receive distributions in the current year from your 401k. However, I still recommend that you look at this as the last and final option. Saving for retirement early and often is critical to be able to enjoy and actually retire. Withdrawing from your retirement accounts early, even if you pay it back, reduces the amount of growth available to you over the next several years. We hope you enjoyed this video and found it useful. Please hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.